Welcome guys, welcome. We are going for another video about the common accounting terms all the business. So now we are going to see debit and credit. Okay. So what is the debit? So what is the debit? Debit definition what? So debit is nothing. See, for example, debit is an individual or entity. Entity means company, correct? The company that owns money to the business. Okay, the company treat as assets because they will get money from them in near or distant future. Okay, then accounting entry is there either increase assets or decrease the liability on company balance sheet. So this is the debit. Okay, debit I can explain easily. For example, if you are individual, if you are not, you are the company, that is not a problem. If you are getting money from third party, this money is coming inside the company or inside to you, that is from the debit, because money you are receiving from the someone. At the same time, this is for the assets, correct? Like a current asset, because if with money with me now, it's a current asset. Tomorrow it's I don't know, it's I'm going to spend somewhere, correct? Is the current assets. This money I am getting from nearest or distance, maybe this future I'm going to receive or not. This is debit. Whenever I am going to receive the money, that is debit, correct? At the same time, increase the assets or decrease the liability in the balance sheet. You can see debit means what? Increase the assets, decrease the liability. You can easily understand. If you receive the money, that is your asset is increasing. That means your liability is going to decreasing. If you pay the money, what is going to happen? Decreasing the asset, increase the liability. If I am going to take the loan, that means my liability is increasing. You can see the credit. Credit. A creditor is the individual or company to own a business owned company, own money, sorry. So that means what? We have to, for example, if we are going to pay, we are going to take credit to someone, or we have to make the commitment to them. So that once money is go from out, that is going for the credit side, correct? This company treat a liability because this is the liability, current liability, we have to pay. Current liability, we have to pay that one. This current liability are like long-term liability, short-term liability, that is not a big deal. We have to pay, that is called credit. That is nearest you have to pay, or distance you have to pay, the future you are going to make the payment, but that is for the liability. And accounting, see the same thing, decreasing the asset, increasing the liability. The balance sheet, I already explained about the, when I explained about the debit, at the same time, decrease the assets and increase the liability in the balance sheet. So you can understand very easily what is the debit and credit. Debit means whatever you are receiving from some third party or someone. Credit means you have to pay to someone or third party, a vendor or supplier or whomever you are going to make the payment. That is for credit. Whenever, say debit, whenever you are receiving the money, or okay, at that time what is happening? Your asset is increased, liability is decreased. When you are committed to pay someone or you are going to pay someone, your asset is decreasing, because this money is going out, your asset is decreasing, your liability is increasing. Okay guys, thank you. We will see next common elements.